And we're really excited for the people that we have here today talking about raising life sciences capital. I first want to thank Bakertilly, sponsor of this program, for their support as a founding leader of PACT, and again, of this program in particular. Again, just webcast etiquette. I think you all know this. You're all muted. Please use the Q&A window at the bottom of your screen to ask questions. We will make sure that we certainly look at that and insert those questions into the conversations. The chat window, of course, is certainly available for you to comment, say hello, communicate with your fellow participants. So with that, let me hand the mic over. And first, just a quick word. You know, we have seen just incredible things happening within the past year from a business perspective. And not the least of these are the advances that we've seen in the life sciences space. Yes, COVID has taken a lot of that from a press perspective, but the companies you're going to hear from today, the investors you're going to hear from today, have some incredible stories of fundraising despite a pandemic. And so here to help moderate that discussion, please join me in welcoming PACT board member, Immanuel John, partner at Bakertilly.
Great, thank you, Dean. Good morning, everybody. Good morning and welcome. As Dean mentioned, I'm Immanuel John. I'm a partner with Bakertilly, serving public and private companies. We are very proud to co-host this session with PACT today, and I'll be your moderator. Our goal is simple for this thing: share ideas and best practices to the community for our collective success. We have assembled a great panel today, and I'll ask each one of them to introduce themselves. Take a minute or two and introduce themselves, and then I'll come back and we'll start with the questions. So with that, I'll hand it over to Kapila. Kapila?
Morning, everyone. Thanks for joining. And Dean and Immanuel, thanks for inviting me to be on the panel. I'm a partner with the healthcare fund at NewSpring Capital. We're based just outside of Philadelphia. And at NewSpring Healthcare, we focus mostly on services companies. And these are services to payers, providers, pharma, and patients. We will do a small amount of specialty pharmaceuticals, but we tend to be very selective on what we do. And across the board, the kinds of companies that we invest in are already past what I would call their first customer, if you will. So we're looking at companies that have sales revenues of anywhere from 10 to 100 million. And typically, I would say right around the time of investments, companies tend to, on average, to be around 20 million of revenue. With that, let me turn it over to the next speaker.
Roger, I believe it's you.
Okay, it's me. Good morning, everyone. I'm Roger Carlin. I'm with SCP Partners and SCP Vitalife, again in the Western Philadelphia suburbs. We have a range of funds, but the SCP Vitalife funds are the ones that are focused on life sciences. I have about 270 million under management. Those funds have invested primarily in earlier stage device companies, both diagnostics and therapeutics, but there's been also a couple of specialty pharma investments. And the funds have a particular focus on Israel. About 60% of the investments are sourced from Israel, but then of course often brought into the US to access the US market.
Great. Lalo?
Yeah, good morning, everyone. Yeah, Lalo Flores here, CEO of Century Therapeutics. As way of background, I have a technical background. I have a PhD in biochemistry and molecular biology from right here next door from Rutgers University. I transitioned right after grad work to industry. So I've been in the industry for over 25 years now. I've begun my career in the Bay Area. Startup called Lalo was acquired by Amgen in 2004. But I came here to the Pennsylvania region, recruited by Merck, the campus here in West Point or Upper Winnet. and where I spent almost about 9 years working in different therapeutic areas in R&D, in various R&D roles. And before I started my first company, called Therapeutics in 2009, this was, in the middle of the financial crisis. I can have some stories about fundraising in that period. But that was a successful story. We were the first one to prove that we can develop a new type of antiviral for hepatitis B. That led to the acquisition of that company by J&J in an all-cash transaction in 2015. And then, I wanted to be an entrepreneur again, and I joined forces with Versant Ventures to start Century Therapeutics in 2018. And I've been working on getting this company off the ground ever since. So I look forward to sharing, the fundraising stories with the audience today. Thanks.
Great, thanks, Bruce.
Yeah, thanks very much. Thanks for the opportunity. Really appreciate the invitation from Dean and Immanuel and joining the panel. So I'll try to be brief, but go back quite a few years to the Philadelphia connection. I have a PhD from University of Pennsylvania, so it's a big loop back to the Philadelphia area. After that, I worked in academia for several years, and then moved to Johnson & Johnson for 8 years, and then a series of smaller biotech and biotech companies, essentially small molecules, mostly in the oncology space. Prior to joining Passage, I spent a year at Deerfield as a venture partner, starting a company for them, and also worked a lot of their academic collaborations, which was an interesting experience for sure. And then I joined Passage Bio as CEO about a year ago, just before the pandemic hit and just as we were going public. So I'm sure we'll talk about that as we talk about fundraising, because I think we were the last IPO to go in person, kind of on the road. Maybe not quite the last, but we were certainly one of the last in the biotech space. And at Passage Bio, we're a gene therapy company that is essentially partnered very closely with Jim Wilson and the team at University of Pennsylvania's gene therapy program. And we've built the company in Philadelphia, as well as starting a research site for manufacturing just outside of Princeton in the Hopewell, New Jersey area. So I'm really looking forward to the panel today. Thank you.
Fantastic, and thank you. Thanks to everybody. So we'll start with the broad questions. So generally, as a short answer from the panelists, how did you all fare during the pandemic? It is a 100-year pandemic. First experience for all of us, right? So how did you all fare? So let me just start with Roger. Roger, you have a good perspective from a different perspective, I suppose, from two different countries, right? You're sourcing from Israel, you said, so that gives us an interesting perspective. So why don't we start with Roger, if you don't mind?
Okay, well, across the portfolio, it's not so much country specific, because they're relatively earlier stage companies. Some of the investments that we make are pre-revenue. But, of course, the first and foremost thing was keeping the team safe within the companies. And I think we did a pretty good job of that across the board. But most of these companies are essential, so we didn't have to do the lockdowns. But the impact of the pandemic, it was really a difficult year. No mincing words about it, because it caused delays in product traction. If you were trying to get trials done in the marketplace, those were delayed. In some cases, there, of course, were declines in revenue, and those negatively affected company valuations. That's just the reality. And so liquidity, all these companies are pretty much loss-making companies consuming cash. So liquidity is an overriding concern in a situation like that. And you do things to mitigate the rate of cash consumption, and then in some cases you have to do fundraising under less than ideal circumstances. I mean, that's probably euphemistic, pretty adverse circumstances. So that was the situation. I mean, we have 3 companies that are public now. In those cases, it was at least financing can get done. Sometimes not very fun. The terms depending on the timing in the pandemic, we had to do one relatively early on in the pandemic, sort of in the worst part of the time, but that's the reality. And those terms were pretty onerous. Almost all of them had to be done with some warrants, and the warrants trended toward 50%. So, you can access funds and cash if you really need to, but it's punitive in some cases in terms of dilution. The private companies, that's even more difficult because obviously investors don't know how they're going to get liquid and when. Those companies that could show some sort of clear market traction, clear path to market traction, or a reasonable story that they're pre-IPO, in those cases, yes, you could get some financings done. Other companies that were going sideways or in decline and the outlook was really, really cloudy, that just was almost a bridge too far. And so it became a case of, well, how do you preserve the position? How do you buy time? How do you create some liquidity? In a number of cases, PPP loans were helpful in doing that. We did access those both on the private and the public side. So it was kind of a year of triage. But in the middle of all of that, we did get one company to quite an interesting exit through a structured M&A process. I can talk about that more later, but that essentially is sort of a hybrid between fundraising and an exit, but that worked out very well. But that company had, gotten to a point where it had all its FDA approvals, it was in the marketplace, it was showing market traction. Clearly the product was really, really strong winner. And, so the ability to raise funds is very dependent on the story you can present, stating the obvious.
Thank you, Roger. Challenging, needless to say, right? So let's get a company perspective. Lalo, how about you? How did your company manage during the pandemic?
Yeah, thank you. Well, obviously, look, 2020 was an extremely challenging year. We were, something can help us in Century, by the way, for all of you who do not know the company, Century Therapeutics. We are developing allogeneic cell therapies for cancer. We're using an exciting technology called induced pluripotent stem cells. And, we emerged from stealth in 2019 with, well-funded, we have raised significant amount of cash, we have a significant runway, so that we were not in the need to fundraise in 2020. So that was not the priority, but for any private company, keeping the timelines, keeping the progress, keeping the, it's central, right? Because, we all need to raise more money regardless of your financial situation. So it was, it was critical that we were, scientists were considered, essential employees. So we were able to manage, early on, we had to decrease capacity by 50%, making sure we're adapting. Everybody else stayed home except for the research scientists. But then back in June, we're able to find a way where everybody was back in the labs. And we, we're working at full capacity back in June. So, we're only a couple of months where we're all adjusting to these periods of tremendous uncertainty. And I have to say, ever since, we haven't had a single COVID case at the company. The team where we are, kudos to them. There were excellent protocols put in place. And we have managed to grow the company. We began, we're 40 employees when the pandemic, emerged in March, April, and we hired over 60 people during this period. And I have to say that there is a silver lining with this, and that is that, for example, and we're going to talk about fundraising in a second, but even for recruiting, it becomes so much more efficient, for where I was extremely concerned. I need to keep growing the company, how we're going to need to keep adding the critical mass, how this hiring would slow down. But it turns out by avoiding all these trips and in-person, interviews and in these complex interview schedules and doing everything over Zoom, it turns out that our hiring and recruiting proceeded unabated, very efficiently, and we have had really no delays from a hiring perspective. Onboarding people, of course, remotely is not the same, right? Building those relationships have been, a little bit more, challenging. But if you put everything in place, you're proactive, maintaining, onboarding, employees. I have to say that, we look back and we think that probably we're not sure who could have been so effective in recruiting the way we have done through the pandemic, going completely virtual, right? Doing everything through Zoom and avoiding, all these the logistic challenges of the way we used to do business, right, pre-pandemic. So, that said, for that reason, I think we managed very well as an organization. When I talk about fundraising, of course, in the fall of 2020, decided that it's time to start thinking about the next round of financing. Some of you have seen, we're able to have a very successful financing that closed this March 1st, I believe we announced this. Again, it was all done, virtually. We met large number of investors, and again, in a very short period of time, to me, it was really remarkable how efficient the fundraising turned out to be. We met, maybe 50 or so investors over Zoom in a couple of months, and then we have a term sheet, before the end of the year. So that part of that, of course, we'll be making good progress. We'll have a good story, but the speed at which you can set up these meetings, the flexibility that you have by being fully virtual, I think there's a component where I could say it's an advantage, right? If you have the right story, if the company, sometimes, of course, I'm not saying, I don't think that, that personal in-person meetings will go away, but I would just want to say that it has not been virtual, has not been an impediment. If anything, would help us in terms of this efficiency.
That's great to hear. It's great to hear that you were able to innovate and adjust and actually grow. That's fantastic. So, from a CEO perspective, I'll just ask Bruce this question: How did you prepare to raise capital? As you're answering this, did you change the list of your potential investors? Did you target them differently? Did you change your focus, where to highlight your pitch, things of that nature? So from your perspective, how did you manage that?
Yeah, no, that's a great question, and thanks. So, I think I echo a lot of what Lalo just said in terms of company building and also moving things forward. Very, very fascinating case studies to say that if you can, and the story is strong and you're able to continue to move forward on your milestones, the virtual approach doesn't really modify very much. So we actually, and maybe we'll talk about this at the end, but we went public just at the beginning of the pandemic. As I mentioned, we did do a secondary offering earlier this year, and it was very successful. We decided to do that basically after a series of things that occurred. So in the fall, we spent a lot of time, exactly as Lalo said, basically at virtual meetings. We had really great analyst coverage at the beginning of the IPO, JP Morgan, Goldman, Cowen, et cetera. And there were some additions, and we took advantage of all of that to attend many different conferences virtually, which allowed us to, I think, spend time to build the relationships that we had at the beginning at the IPO. For example, some groups that had not come in as investors, and we continue to target groups that showed a lot of interest in the story, but we did this all virtually. And so I don't think that there were a significant change. I would say that there was not a significant change to how we modified the capital raise during the pandemic, except for, as Lalo said, a very high level of efficiency. And one example of that is we might attend a meeting where investor X is not available anymore because their calendar is full, and the meeting just kept going. So it might have been a 2-day meeting on a Thursday and Friday, but we'd still have investor meetings scheduled from that particular in-person meeting and after our virtual presentation on Monday or Tuesday or Wednesday as it worked out. So we were able to extend these relationship building events outside of the formal timelines. And sometimes those meetings would actually get longer, because instead of the 15-minute meet and greet slot with an investor, you'd have the flexibility of going to 30 or 45 minutes. And so it was all virtual and very efficient, and essentially key meetings like JPM, which we can talk about, JP Morgan this year, without all of the receptions at night and 6 a.m. meetings or board meetings, et cetera, in between various things, was incredibly effective at meeting existing and new investors. So the virtual aspect of this, from my perspective, actually was incredibly efficient. I think where it gets difficult is where you're starting and trying to start to build those relationships. We obviously had the advantage of having a very strong Series A and B, and also the IPO, and also analyst coverage as we were going public, to build those relationships. And so I do think, from the perspective of raising money where those relationships do not exist, it's probably can be harder, because you're trying to get in front of people and build those, build trust and build transparency all virtually. So it just requires perhaps a bit more time, but the virtual nature of it does give you that flexibility of having one-offs as opposed to all concentrated around specific meetings or travel.
Yeah, thanks, Bruce. So looking forward, just if I could just follow up, how do you see, 3-5 years down the road? Do you see a hybrid nature of, or just continuing the virtual aspect, which I don't think is going to be the case, but how do you see looking forward?
From my perspective, I certainly hope so. I think it would be perhaps a mistake to require everybody to be in person. I do know over the summer there are some conferences that are starting to ask that very question, which is, if local regulations allow, would you go in person? Would you want it to be 100% virtual, or would you want hybrid, where perhaps the initial presentation might be virtual, and then some investor meetings are in person, or vice versa? And when I look back at JP Morgan, there was an incredible reach for investors, because everything was recorded, everything could be accessed offline. The current JP Morgan, just as one proxy for this setup, you really have to be there, and you have to attend meetings in person. And that virtual nature does allow a lot of flexibility. And I do think that I hope that continues. And I think the international component is also really important, because it does bring in, Roger mentioned Israel. I mean, there are investors in Europe, in Israel, Japan, China, et cetera, that might be able to access conferences along the way much more readily if we go to a hybrid system where there's opportunity for both virtual and in-person meetings. So I'm hopeful that efficiency and that access continues.
Fantastic. And Kapila, from an investor's perspective, similar question on, how did you prepare during the pandemic for investment opportunities, and also looking at your portfolio companies? So let's hear the investor's perspective.
I will echo Bruce on one thing. I think it is going to be next to impossible to go back to 100% in-person meetings. I mean, where I'm sitting right now, I'm already saying, if it's the first meeting I'm having with a company, and that company is a 2-hour flight away, I'm not going to require them to come here, nor am I going to say I'm going to go out to meet them. The first pass will be through Zoom or Teams or whatever the means is, so I think first meetings are all going to be virtual. And then when there is real interest, that's when you start to develop, like Bruce, you yourself said, that it's easier if you have an in-person relationship already built, but you start to build that after the first pass to see even if there is a fit at a high level. So from that perspective, I think what we did last year, and we were on both sides of the table, we were very active as investors. We put a lot of money out to work, but we also sold companies. And one of our portfolio companies was bought by a bigger private equity firm, and they did their diligence entirely virtually. They didn't even meet the management team in person before buying the company from us. So I think virtual is here to stay one way or another. I don't think it's ever going to go away. I think, there may be occasions where it goes to hybrid. There may be occasions where, you say you make the investment and then you want to sit down with your management team. It's important to get to know them, get to, build that relationship. But I echo what both Lalo and Bruce said. I think we found a lot of efficiency by eliminating the travel. And we saw that with our portfolio companies, with our investment, process. Last year was, I will say though, listening to what Roger had to say initially, I was sitting there thinking, it wasn't so bad for our portfolio companies. Maybe they took a bit of a hit, call it the March, April, May timeframe, but they bounced back very quickly. And the way we do investments, we focus a lot in on the management team. So the people we're investing behind, that's very important to us. And we invested behind good management teams with good stories. It wasn't just that it was a good story, there were good people, executing on those good stories. So our portfolio companies fared pretty well, and some of them actually beat their budgets. So I was quite surprised, pleasantly surprised, but I was also very proud of our management teams. They did well.
Great. No, that's great to hear. So you touched a little bit about due diligence, but related to that, how about financial projections and financial statements? I mean, if it were, it is challenging to get those from companies, as even before the pandemic. How did you all adjust, and how did you get that information? And what was your perspective on what you got from companies? And Kapila, I'll just let you stay with that.
I'm happy to start, and then I'd love to hear Roger's perspective. I will tell you that I don't think any of our companies was spot on with their projections. Some of them exceeded, some of them didn't quite meet it, and it was all over the place. And when we went through the budgeting process for 2021, every single CFO of all our companies basically said, well, I don't know how accurate the base case will be, but here's a downside, here's an upside, and I don't know what's going to happen. And every single one has said that they will revisit every 3 months to make sure that they're staying on top of things as things open up and, other opportunities come up. I have to say, projecting for 2021 was very challenging because you had no idea what was going to happen. So,
yeah. And Roger?
Yeah.
Sorry, Kapila, were you done?
Yeah, I was going to hand it over.
I think that's the same. Roger. There's just a higher degree of uncertainty. So, you ask them to do multiple cases and you update more frequently. That because the information changes, the outlook changes. So you just have to stay more on top of it. We weren't quite as fortunate as Kapila because we had, drugs that were trying to get newly sold, and all the elective surgeries are getting postponed. We have a non-opioid pain reliever for elective surgery, so you just can't push that into the market when people aren't doing elective surgeries. And then, as I mentioned before, if you have trials that you're trying to get done, the same issue applies. So yes, you reforecast and you update frequently, and you see what that means. But the information did change a lot. It started to open up in the second part of last year, and now it's really opened up a lot more. So in fact, projections are increasing more than I would have expected. So.
Yeah, and Bruce, how about from a company perspective? How did you guys all manage that process?
Yeah, so there's two aspects of our business which make things a little bit more controllable. One is that our research from a preclinical perspective all the way through IND is actually in partnership with Jim Wilson and the gene therapy program at Penn. So unlike what Lalo was saying, we didn't have to be concerned with people in the office and in the labs. It was actually managed all through Jim, which he did a phenomenal job, and great partnership with them. And they also work on at least the initial manufacturing. We do have, that's the one biggest variable. I'm sure Lalo can comment on this as well, from cell and gene therapy is trying to manage the manufacturing process. And that was the biggest, I think, uncertainty about whether we could effectively work with our third-party CDMO, Carolin, we were able to do that, and we were able to actually advance 3 INDs through the year based on those partnerships. And that led to essentially the forecasting process about whether those external relationships would be able to deliver and support what our internal team could do. And then the other wild swing was also whether we could execute the hiring. And we had aggressive hiring just like Lalo did. I think we started the year last year with 20 people, and we ended around 80. So it's probably the same kind of numerical growth that Lalo put out. But going into it, there was high uncertainty. We just had no idea how it would play out in early 2020. But we did exactly what Roger and Kapila was saying, which is essentially look at a base case, look at what those swings could be. A lot of if-then conversations were going on, and then this year is continuing to be the same. And we don't, the access in terms of our financials, it's all public information, right? So all of our fundraising is through prospectus, and so we don't have to worry as much about the reach in for. Don't mean to say that incorrectly. The reach in from venture groups and financing to do all of the diligence that perhaps a private company would do, but certainly it's the same aspect internally with our board and thinking about the financial projections. So a lot of variability and just managing that and thinking about what the big swings are going to be.
And in fact, we all made it to 2021, right? So that's great. So Lalo, so every experience we learn lessons, right? So are there any lessons that you've learned, mistakes to avoid during the process that you can share with the audience? You're on mute, Lalo. Sorry, Lalo, you're on mute. Sorry.
Sorry, thanks. Yeah, no, as I answer that question, I want to circle back with a comment earlier and advice for entrepreneurs or people who, anybody who's fundraising, right, in the next few, now or in the future. I do think that, I encourage them to not to shy away from these virtual meetings, really, especially when you're, as I said, my previous entrepreneurial experience was a very different type of company, and it can be very onerous, not just time consuming. We're talking about efficiency, but also onerous for an entrepreneur that hasn't raised money yet. And doing this virtually, it is really the way to go. Even building the relationships for the first time. So we just completed a crossover round, 160 million. We announced in March, as I was saying, and we brought in 11 new investors to the company, to ours, and those are all groups that we met for the first time during the pandemic. And so the relationship building can happen effectively. Of course, you need multiple meetings, and even that is something that you could never, it would have been very difficult to do using the previous model, right, where you feel obligated to in-person meetings. It would have been impossible to do that. Doing the whole diligence process, everything, of course, you need to have a good partner for that. But lessons learned, I think, this is a major lesson learned for me. Everybody I speak, is that we should continue to embrace everything that works using this virtual model, right? And supplement it as in a targeted way for certain, for certain interactions where you really, strategic meetings, for example, where you're really, it's not just where you may meet in person. So I think from that's a major lesson learned. I would not shy away to continue to use this model that we all have learned to live in, using, leveraging these remote virtual interactions. From a company perspective, I think, as I said, running the business from a financial, very different situation. Like Bruce was still pre-revenue. We're not, managing your research activity, including your partners. But I have to say that everybody that we've been interacting with, they have managed to work effectively using this model, right? So I would say embrace it, and certainly I will continue to use it, even as we get over this pandemic. Use a different model. Even the work, for the employees that don't need to be at the labs, the remote working is something that we all will need to be thinking about. What would be the right model to run our companies, right?
Yeah,
Right.
I would just echo that quickly, and I would say, one of the benefits is that the pace. You can contact a lot more people a lot more quickly. You can reach a much wider geographic spread more quickly, and you can be more responsive to. You can have a dialogue. We can all be responsive in email. Of course, we know how to do that, but that's not the same. You can't have a dialogue, a Q&A. And so I think in many, many ways, using the virtual model, Zoom or whatever you like, can accelerate the pace of fundraising. And you can figure out what are the dead ends quickly too, without getting on a plane and going and having a meeting that's a waste of time and 3 days of travel and whatever. So absolutely. And from an investor perspective, I don't see any negative, and I don't feel like I need to see people in person every time, even at the outset.
Yeah, great. I'm going to take an audience question and see if I'll just throw it out there. Maybe it is to the investors, but anybody feel free to answer this question. So the question is, when looking to raise capital, how do you decide between debt and equity mix? Any response to that?
I'll make a quick comment. I did see that question and I started to wonder what kind of company, what stage of company. It really depends. If you're a complete startup with zero revenues, getting debt is next to impossible, right? But if you have institutional investors, we have relationships with a lot of, call it venture debt, as well as later stage established banks that will provide so even debt, it depends on the stage of the company, it depends on the type of debt that you're looking for. If it's a line of credit, no problem. If you're looking for a small term loan, again, it starts to get to, are you looking for debt terms that are friendly to the company? Are you looking for more stringent capital that is cheaper? If you want debt terms that are more friendly, it's going to be more expensive. If you want debt terms that are cheaper, covenants are going to be more rigorous. So the answer from my perspective is it depends on the type of company.
Now, fair enough. Roger, anything to add to that
Yeah,
quickly?
no, it's obvious. It's very company specific.
Yeah.
And if you're doing earlier stage debt, the venture debt, as Kapila mentioned, the venture debt lenders are all going to be looking to the institutional investors around the table as the backstop. That's the only way they're going to be willing to lend to the company, is they're going to know that the institutional investors, if something takes longer or goes bad, are going to be ready to put in more funds. So generally, I'm not a big fan of debt for early stage at all. Later on, when you start to have revenues, or you start to see that you have a path to the next financing that's pretty high probability, or an IPO, okay, that can be a cheaper way to bridge yourself there. But it's not at the top of my mind. I've done
Okay, good.
I've done
Fair
a fair
enough.
amount of it, so.
Sorry. Speaking of stages of companies, Bruce, how about you mentioned the IPO? Looked like it was a very interesting time, but anything that you can share from that experience to the audience, with the audience?
Sure. So I'll try to be really brief. To give some background, I joined the company at the end of January, and the team, including Joe Quigley and Rich Morris, Chip Kale, who were in place, and our interim CEO Steve had essentially prepared for an IPO, and had used the fall, basically October through December, and then JP Morgan to lay the groundwork and test the waters, et cetera. So I joined 2 weeks before we got on the road, and we had 8 roadshow days. And what happened is that the last week, essentially the week of the 14th or 13th, was when the 24th was when the pandemic really started to hit with the outbreak in Boston, and there were 33 or 40 cases. So the last 2 weeks of February, everything was off about 10%. And then February 27th, when we actually priced, the markets were down about 4.5%. And we say that we did this intentionally, of course, it's completely fortuitous. We were the last IPO on the road because our financials were essentially going, becoming stale, but we're still live. Beam and others had just gone public the week before. It was a very strong IPO market. And our target was $125 million, and we raised actually 248. And what was happening as the market was going away to a certain, with all the uncertainty, is I think there was a lot of, we had a very strong story, don't get me wrong. We had Jim Wilson backing us. We had multiple INDs that we were planning for last year. But I think the other thing that happened was there were no IPOs. Nobody knew if there would be another IPO in the foreseeable future because the market was softening, and there was money around because people were coming out of the markets to a certain extent. So, this, and the other idiosyncrasy is this is the last quote unquote in-person IPO. We've met our investors over the year, and they keep saying, yeah, you were the last group that we saw live. And so it was quite an experience because we had no idea how this was going to price. As we were doing the roadshow, we saw the markets kind of struggling. Let's just put it this way. So it was incredibly successful. We're very happy. Obviously, we did it. But it was uncertain up until we priced, and obviously a very successful story.
I'm glad to hear that. So this again is a question to the entire panel of who feels like, I'm not sure if your experience with this, SPACs. SPACs seem to be the hottest thing out there. Well, depends on who you speak to at this moment, but it's been very hot, right? The last a couple of years. So there are multiple billions of dollars being raised through SPACs. The SEC tried to put a damper on it, but keeping that aside, anybody on the panel want to react to that? Have you had any experience with a SPAC? What are your thoughts on that? Is that a good vehicle to use? Sorry, Lalo.
I can make a comment on that. Bruce probably look into that as well. I have asked, like many others, a lot of questions. We have all witnessed, how trendy it has become, and the conclusion that I have come is that SPACs are great for sponsors, and they have some advantages in terms of speeding up, the process of if that is the key driver for a company. But the traditional IPOs and remains the preferred path for the public markets, I think, regardless of how much SPAC activity is out there. But I don't have personal experience, but as a company that finished a crossover, it's things that I do look at the options, right? We all as no matter where you're sitting as an investor or running a company, you need to look at all the options and study them carefully. And like a previous question, it all depends on the company as well, right? It's all company specific. It depends on your drives. There could be advantages for SPACs, obviously, especially on the certainty of the pricing and the speed at which you can do things. But it's all company specific, I would say. I would just encourage everybody just to look at your own situation. But at least from my perspective, it's not. I still favor the traditional path.
Okay.
I was just going to add one other comment, which is just the lockup and the liquidity, because what you're doing with a SPAC is essentially, venture-backed companies have the same sort of issues. It depends on how much inside ownership there is. But to Lalo's point, the traditional IPO or even a reverse merger allows for more investors to come in, much more liquidity, et cetera. And a SPAC may be the concentration for longer of essentially the SPAC ownership, et cetera. But again, I agree with Lalo. There are certainly circumstances where it probably makes a huge amount of sense. And we've obviously seen some very successful, public offerings or public transitions via SPAC vehicle recently, like even yesterday with Roivant, right? So
it's from the investors, any reaction to that, or?
Well, I'm sure there's some bankers and other finance folks on the call that have opinions. You know, the last I looked, there were something like 400 SPACs outstanding. About 57 of them, I think, is the count that are healthcare focused. So there's a huge amount of capital been raised, obviously, and I'm seeing kind of average deals like the 250 range to do most of the SPACs. So smaller deals are harder to come by for earlier stage companies, but that does seem to be evolving, changing. There's so much money now. I mean, we have a couple of pre-revenue companies that have been approached by SPACs who are very, very interested. And I think you should view it, if you're going to look at it hard, as a fundraising mechanism, right? It's not really a going public mechanism. I mean, you can get funds in the company. I think as these SPACs, their time window clicks down, they have to get to the point where they want to do a deal. Otherwise, the sponsors are going to lose the expenses they've put in. So they're motivated. I think we're going to see more of that urgency as these SPACs mature into their end of their lives. And that could present some opportunities for companies looking for financing. And particularly earlier stage, smaller companies, I think. And so if you look at it as a fundraising mechanism and you believe then you have a good growth path after that, because you're going to have to build ownership and investor interest as a small public company, that can be okay. The risk, I think, is, you know, you get yourself public and now, you know, there's a little interest and you're trading by appointment and you kind of become a zombie public company. That's not really a good outcome. So there's trade-offs. Compared to venture money, though, I think that the SPAC money might be becoming cheaper. And we're seeing some sponsors who are, to get deals done, willing to throw in parts of their 20% percentile, give them up, you know, and end up with a much smaller percentage. So that tells you they're getting motivated.
Yeah, great. So a general question to everybody. So I'll start with you, Kapila. So did the life science industry have a leg up, an advantage during the pandemic to raise capital just because the nature of what we were dealing with and the view of those things related to the industry? I'll go around the thing and start with Kapila. Go ahead.
So let me just say that certainly broadly, both the life science, you know, pharma, biotech, we've taken a lot of hits over the years. You know, we're the bad guys. We don't know how to price things correctly. Where, you know, you name it, everything's being thrown at us. But then I think the one thing that the pandemic did show is, whether you like it or not, if you're ill, you need those drugs, and the only people who can get the drugs to market are the ones who've been doing it for a long time. And I have to say that the speed with which these vaccines made it to the market, the speed with which we were able to repurpose drugs to get them into the hands of patients, that really showed the flexibility and the ability of biotech and pharma to really move fast. And that everybody sat up and took notice. I do think that going forward, you do realize, especially for people like Passage Bio. I mean, you know, one of my former portfolio companies, Passage Bio, was a vendor, right? And the portfolio company was one of the manufacturing sites for one of the COVID vaccines. So it's brought into focus for the general public that the service that this industry provides is absolutely critical and absolutely necessary, and even more so in a pandemic than under normal circumstances. I mean, what Lalo and Bruce are doing they're bringing life-changing, life-saving, drugs to the market. And that doesn't change whether it's pandemic or not, but the pandemic highlights what these guys are doing. So to me, I think healthcare certainly is the flavor of the month, but it has opened the eyes of a lot of people as to what this industry really does. and has
Yeah.
been doing and will continue to do.
Hopefully it's for more than a month, but Lalo, how about you?
Well, if I recall the question, I thought it was, I think that being healthcare has fared particularly well. I would echo the comments because, from an investment opportunity, certainly, the vaccine companies, Moderna's of the world, certainly helped the whole ecosystem, helping, people realize the power of what we can do as an industry, right, and contributing. But a number of other things are coming together, have come together. The pace of innovation has increased. The number of disruptive technologies that are available and that can be accessed by companies like ours has really, contributed as well as to the environment we're in, right? So, yeah, I do think that we as an industry, we have done particularly well, and I agree with the comments that, the pandemic has really highlighted the contributions to society because, yeah, and so which is a welcome change because, hasn't been really the reputation of the industry has not been great in the eyes of the public in general. So this is a welcome, change. I agree with that.
Right, Bruce and Roger, any thoughts on that? Roger, you're on mute.
Healthcare is a big umbrella, right? It covers a lot of things. I mean, I think that the types of things that Lalo and Bruce are working on, the big opportunities, that are very development focused. What Kapila said, has shown a light on the power of these therapies that are being developed, whether it's vaccines or cancer treatments. That in many ways it's a new era. So I think for those spaces, I think that the pandemic has not had that really a negative impact. Other areas, maybe services, some of the services have been impacted. Of course, devices where we tend to focus, they're more current market oriented. I think that obviously the pandemic had an effect. So it just depends. But yeah, I think that pharma and life sciences is getting some of the due and the credit that it deserves.
I would just add one other comment that the last year has seen a massive amount of capital coming into life sciences, possibly for a variety of reasons. I think there's technology is maturing enough for things like gene editing and cell therapy and gene therapy, where we're seeing the evolution starting to pay off. I mean, Moderna also obviously has catapulted mRNA into this conversation as well. Long overdue, they would argue, and I'm sure that that's also being borne out. So the raising of the visibility has created this massive investment, and I do think it'll be interesting over time where we see competition for either mind share for various technologies or true competition in therapeutic space, research, et cetera. But there's going to be this boom of companies, and founding technologies that is really going to create a wave that we're starting to see. But I think in the next 2 to 5 years, we're going to see more and more of that realized, which is going to be very interesting because the number of therapeutic options, we're in some rare disease spaces where the advocacy groups and the patients that we talk to have never seen one, much less 2 or even 3 therapeutic possibilities coming forward. And that's what we're seeing in very, very rare diseases, which is fantastic for patients. And it's fantastic for the companies that are progressing these. It'll just be interesting to see how all of this plays out over time. I'm sure Lalo can feel the same feeling in iPSCs and oncology.
That's very exciting news. So from the industry, let's come down to the regions. Philadelphia, I've been in Philly for many years now. So we seem to get, when you talk to some folks, they feel, and I totally believe that it is wrong, but they feel like perhaps they need to go outside the region to look for funding, capital raising. So you know, you hear of Boston and Silicon Valley and things of that nature. So what's your perspective on the Philadelphia region? Maybe the companies first and then the investors. Lalo, any perspective on the Philadelphia region? What all do you guys consider when you were thinking of raising capital?
Yeah, you know, I used to, when I first, as I was saying, my previous entrepreneurial experience, this company Novira, I began at a really tough time, economic times for the region at that point. You know, Philadelphia hasn't gone through this renaissance yet, but you know, all the money I raised at that time was for VC groups that are outside of the state, you know, the Boston area, California, right? They were based there. And so, and the same here, my experience with Century. So I don't think, I used to believe that is a key advantage to have made, you know, the capital co-located geographically. But as we were talking earlier, I don't think that is a barrier really. Especially at this new, we just spent most of this panel discussing about the wonder of the opportunity that this new, you know, model brings, right, where you can interact with people, with investors very effectively. So I don't think that's a problem. In fact, I believe the region has a lot of advantages, right? Access to human capital, you know, experienced workforce. I believe that I'm a major advocate for the region because of all the talent that we have from the pharmaceutical research centers around here. You know, most of the people I've hired at Century are from this region. We have brought people from, you know, the West Coast, of course. You know, we have sites elsewhere. But, you know, this is a great, the cost of living is better than in Boston or in the Bay Area. So there are advantages here. And I look at this as the Mid-Atlantic region, not just Philadelphia itself, right? Because, you know, going into New Jersey, I mean, Bruce, I see, you know, he's setting shop there. We're also going to have a manufacturing site, you know, 45 minutes in New Jersey from Philadelphia. So, you know, so I think I would encourage entrepreneurs not to, you know, this is a great place to start a company. You know, access to talent. It's a lot going for it. And certainly the recognition of Philadelphia now is a completely different place where it was 5 years ago, I think. So I think it's a good place to start a company. I would not feel that you have to go away, and you can recruit capital as we just discussed, you know, virtually. So
that is fantastic to hear, and I think Dean will pay you later after this program. Since we're running short on time, we have 2 minutes left. Kapila, your perspective, anything from an investor's perspective about the region? And then I have one last question for everybody. So
I'll be very quick and very brief. I agree with Lalo. In this day and age, I don't necessarily feel that you have to be co-located with your portfolio companies. I mean, investors are all over the place. Our portfolio companies are all over the place. But having said that, NewSpring has very, very deep roots in this region. And we have a lot of portfolio companies in our history. A lot of our portfolio companies have been in this region. There's a lot of innovation that happens here, and there's a lot of talent that lives here. So I agree with Lalo.
That's fantastic to hear, and we greatly appreciate your investments in the region, and we're very grateful for that. One last question, a minute left, so one last question. I'm going to ask you to take your crystal ball out of your drawers and then look into the future and then see. We talked a little bit about the nature of how people are going to interact and things of that nature, but keeping that aside, what's your future? I mean, we can't predict the next pandemic, keeping that also aside. How do you see the capital raising, business growth / whatever perspective? And I'll start with Bruce and then take one more reaction.
So I think innovation is going to drive this. I really do think that there's going, I mean, I know that's maybe a platitude, but you know, there's so many cutting edge technologies coming out. And what I'm seeing, especially when I looked at some of the deal formations and venture capital, is that platform and preclinical are just skyrocketing. And I know that depends on the investor, it depends on where we're going, but I think the issue is that phase 1, phase 2, phase 3 approved are getting many more deals, much more tied up, different sources of capital, but platform investments, which has led to Moderna as a great example, are going to continue to grow. I mean, that's where the capital is moving, and I think it's perhaps more expensive, but I think it's going to drive a lot of different investments in the near future.
Fantastic. It's 9:30 and I want to be respectful to everybody's time. I want to take this opportunity to thank each of the panelists, Kapila, Roger, Lalo, and Bruce. Thank you very much for your participation and your contribution. You had great things to say. And I want to thank PACT, Dean Miller, and Heidi and Danielle in the background helping us put this together. So thank you to everybody. And we'll see you the next time around.